Well, we talked about buying a stock. Let's talk about selling a stock. Right? We would like to hold a position forever and make us money until we retire and even beyond that, but it doesn't really work that way. Let's talk about when to sell, how to sell, and what that does. They never put those people back on TV, or very rarely at least, and say, you know what? This stock is overvalued. Its products are, weak and it's going to be going down, so you should go ahead and sell this stock. That doesn't really happen. That job is up to us. That's also a bad thing if you take advice, because most people tell you buy, buy, buy. For that matter, even your friends, most of them don't walk up and say, hey, this company is really bad, sell it. Doesn't really happen. So take your profit, which is good. Limit your losses. That's also good. Losing $100 when the trend line breaks is better than losing $500. And we can have more money either way to buy on future pullbacks. So have the exit in mind when you enter. When you buy a position, don't just buy it because, again, someone told you. Have the exit in mind. Where will you exit? When will you exit essentially? Doing a whole position as long as possible doesn't really work that way. To sell and rotate. So take your profits, hopefully, and put them into some other stock. The bad news, most people make a simple but really big mistake when selling a stock. So what is that? What is that big hidden secret mistake that most people don't know? Forced to raise capital, and that means make money elsewhere. If they have to pay taxes, or they have to fund a child's graduation or college or whatever, retirement for that matter, if they have to sell stocks in their portfolio, they actually sell their winners. The stocks are doing really well. I'm up on this stock, so I'm going to go ahead and take my profits and sell it. Okay, well, that's very logical. A lot of people do it. Problem is, why sell what's working? Why sell what's trending up and even maybe accelerating higher? Why do that? It's kind of getting rid of what's not working. Get rid of that. Put that dead money to an uptrending buy stock position. Why sell what's working? And this is the thing we say a lot. That which is cheap tends to get cheaper. It means a stock moving from top left to bottom right. That trend probably will continue. However, that which is expensive, or moving from bottom left to top right, hold on to your winning trades. If you learn nothing else, if you put a position on, if you have to choose two positions to sell, take the losing or the less profitable trade. Take it like a guard and make the others do better. So sell what's flat or at a loss to rotate capital into a fresh stock. So two specific signals if you do use fundamental analysis, and I think that you should, in a sense of determining what the companies are, and maybe analyst evaluation, you can also use Yahoo Finance to give you a target. It tells you this stock, given all of these complex mathematics, I think it should be worth $35 a share. If it's at $35 a share, maybe it's time to sell that stock and rotate elsewhere. That is a price achieving a good target above. Or when price crosses under a rising trend line. That's either to take your profit or, unfortunately, to take a small stop loss. To stop the losses from getting even bigger. So the same thing, you can actually turn to analyst reports. Won't go into that same thing we looked at for Yahoo or Google or the other finance website. Look for the analyst tab. Don't so much read the whole thing if you don't want to, but look at the consensus estimates. You'll find a number usually relatively easy. Price targets, and it's a range. It's a fixed price. You may need to average if there's 6 or 7 or 8 or 9. Just go ahead and just average them and see what the average estimate is. You may also simplify or just simply target. Say when Apple trades to 100 per share. It's almost there right now, at least today. If it trades to 100 or maybe 50 per share, whatever the case is, whatever the stock is, a round number could be a target, and you will sell there and then put the money out to it. That's how you would sell too. The same thing, we watch the trend line is to sell shares. We talked about it, but we're making it formal now. We're actually adding another step. This is price crossing a trend line. The trend may be reversing. maybe, hopefully this occurs a long time after we buy, many weeks, if not many months, if not many years. But if it breaks under that buy trend line, we don't ask questions, we just sell. If you are considered a stop loss order, because you are stopping the loss from getting bigger. It is better to lose $100 per share, 100, than lose 500 or lose 1,000, because greed or fear or our emotions cause us to override our strategy. Lock in profits ahead of a reversal, or lock in small losses to prevent a large loss. This is Amazon. So here's your initial trend line. Let's see, the shares became that way extended from where it was. We just drew another trend line. We drew it from here to here. Price broke this trend line at this, surprise, at a round number at 400 per share. We have a round number target. We have a breaking of a steep trend line. That's a great place to take your profits. And of course, not get into it at that point. It didn't fall immediately. It actually took about a month. It goes sideways, phase 1, phase 2, phase 3, right? But that initial trend line, we had to draw a steeper trend line. Otherwise, we had a couple of, if you wanted to take them, buy signals, and then it broke this other trend line, and then it fell quite sharply. Your ideal sell signal was on the steep trend line, break down.